Hope you're doing well. In today's video, we'll continue with our series of using price action to take better technical decisions on the markets, that is the indexes and the stocks. So today, what I have in front of us is the Nifty 50 chart on the daily time frame, on which we'll be applying some of the most well-known established techniques. In order to learn our views on the longer time frame, I would suggest that you watch our older videos on Nifty. So let's just focus on the chart at hand. The initial observation that we have to make whenever we are looking at a chart is to see the high and the lows that the chart has created. So for example, I'll just select some structure here. So this is clearly a pivotal high that I have marked here. I'll continue with this structure. This too is clearly a pivotal high. We can see a gap up evening star. I'll continue here. This, of course, all of this seems to be like a low, right? So now the question is, with relation to its previous high, what is the status of the current high? And we will see that the current high is lower than the previous high. And the next question is, in relation to the previous low, what is the status of the current low? This is on its way of forming a new low. We'll have to see where it stops. But for now, we have the information of the past. And the information of the past is, what is the relationship between these two lows, where the cursor is placed? And the answer is that they're pretty similar. It looks more like a double bottom. In fact, if we are generous with our assumptions on the high, and we simply focus on the point of most traded value of Nifty, then automatically we will come right here and we can extend this right up to this point, and then we will say that okay, this is the broader trading range of the market. So in other words, whenever we are measuring the ranges, one way is to look at the pivotal highs and lows, which is what I normally do, and another way is to look at the maximum time spent by the market at a particular point, which is also what many people do and you should be aware of. Regardless, if you look at the maximum time spent, you're pretty much going to find 25,300 to be the resistance. If you're going to look at the exact previous levels, then of course we are going to find 25,600 to be the resistance. Regardless, given the nature of the previous lows and highs, we can safely say that this is a ranging market. And now the question is that whenever it's a ranging market, what do? We look for the possibility of patterns. And in which direction do we want to trade the pattern? And for that, we'll have to see what is our view on the longer time frame. So if you see the view on the longer time frames, it is long. In other words, if I find a bearish pattern, I will simply ignore the trade. But if I find a bullish pattern, I would like to take the trade because it is in the direction of the longer time frames. So now, once we look at what we have established here, I will remove these areas and simply focus on the lows, because like I said, that I want to first establish the presence of a bullish pattern. And when I connect these two lows, I need 3 touch points, so I have 2 of them. One hypothesis is that Nifty will pretty much come and stop near 24,500. That is, it's currently at 24,650. So approximately 150 points is lower is where one hypothesis could be. That is the closing value. Of course, there could be some whipsaws and things like that. But pretty much 24,500 seems like a reasonably good place for Nifty to create a new low and hopefully even stop there. And why should it stop there? Because this particular level is coinciding. That is, this level right here coincides with price dating all the way since May. That is approximately 5 months. If Nifty does stop here, and by stop I mean it creates a low and then consolidates in this region, spends a few days time, and then we see some candles like this, for example tweezer bottoms or marubuzos, that is bullish belt holds, etc., then in that case we will say that Nifty is trading with a very, very weak bias. Because of all the long biases, if the market is trading on a trend line, it is generally weaker than most trends, because trend lines are flatter. For example, if I was to simply add a 50 or a 20 period moving average, you will see it form a snake-like pattern. So it doesn't look like a good structure. It doesn't look like a trending structure. So the bet here is that the market could take a long side turn after confirming this particular low. That's the hypothesis. And now the question is why? Why are we looking at this? Of course, one point is that I mentioned that in the longer time frames, Nifty is trending higher. But the other aspect is the break of this particular pivotal high, which I will just darken this color. So this point right here where I made the horizontal line was actually a pretty important lower top that the market had formed, and the closing of the market above this signals a change in trend. And since this is the first signal in change in trend, the market had choices: either form a shallow pullback and get into a strong trend, or create a deep pullback and get into an extremely weak trend. Deeper the pullback, the weaker the trend. And I think that the hypothesis that the market could in fact turn will remain true till as long as Nifty is trading and closing above 24,500. Of course, if this is to break, this should be a surprise. This should be a surprise, but the downside that opens up for the market is quite significant. So if I had to take a bet, I would simply take a bet that the market is likely to hold this. And how would I take this particular bet? I would wait for the market to actually test this level and then stay, like that is once the price correction is done, that is from 25,500 all the way up to 24,500, which is approximately a 4% pullback, which is good on the daily time frame. A 4% pullback is quite strong. So a 4% pullback on the market on the daily time frame, and then it spends some time here forming certain bullish candles. I would feel more and more confident with each passing day that the market stays above this level, that this is more likely to trend up than down. Of course, if the market breaks this and starts trading lower, that is, if I, instead of a ray, I simply select a trend line and I say that the price actually extends lower, then this trend line that we are making here simply doesn't hold good. We will have to remove this, right? And we will see that the market is trading in an erratic range, that is, there is complete absence of trend, and we'll simply have to book the losses on long position and close the long positions in the market. Because if the market indeed does decide to break what we would consider at least a 3-month low and do so decisively, I think it would be enough justification to take short-term losses, because the downside of the market is a full 2,000 points, and you don't want your portfolio generally to experience that kind of a fall unless you're really committed to a particular concept. In the short term, of course, what really stands out in terms of price action is the occurrence of this gap. So we have obviously seen in our lives there are breakaway gaps which market breaks and never tests again. This is definitely not that. This is something that the market has repeatedly tested. The fact that it is at a gap support and the fact that there is a weak trend line in play, something that we had created here, right? So just here, and this looks like a reasonably strong. This looks like a reasonably strong chart for range traders to buy under oversold conditions. This is of course oversold, but you need some sort of confirmations in my view. So to wrap it all up, I think that the market is ranging on the daily time frame, and if the market is ranging, then of course trades on both sides are possible, long and short. Generally what you want to be doing is wait for the oscillators to become oversold in order to go long, and you could also wait for the oscillators to become overbought in order to go short. But like I mentioned, for example, right here we can see that the oscillators were indeed very overbought. Similarly here the oscillators were very overbought, and here they were oversold, right? And in both cases the long sides were rewarded. Now once again we are in oversold conditions, so obviously going short here I think is just too much. I think it's selling an oversold market does not make any technical sense. So the only question is going long, and the hypothesis is range with a long bias, and typically what we want to do is we want to ideally wait for some kind of confirmations before we take that particular trade. With that, I hope that we have captured a few concepts which help you learn and reinforce those concepts in your own understanding of price action. If this video is beneficial, to engage with the video through a comment or a like, because generally I use that as a feedback to assess the relevance of the videos that we're making. And I also appreciate all the kind comments that have already been shared. It's encouraging. So thank you so much for your time, and I wish you all the best.